U.S. job growth slows down. What this means for the economy. The U.S. added just 73,000 jobs in July, with prior month figures revised significantly lower, sparking debates over the labor market's trajectory. Non-farm payroll growth was slower than anticipated, and the unemployment rate rose to 4.2%, raising concerns about potential economic instability as President Donald Trump escalates tariffs. The Bureau of Labor Statistics reported July's jobs gains at 73,000, slightly above June's 14,000, but still below the 100,000 estimate many expected, according to the latest data. June and May totals were sharply revised downward, falling by 258,000 combined from earlier estimates. This revision underscores the volatility in employment numbers, which have been increasingly scrutinized amid shifting economic conditions. The unemployment rate climbed to 4.2%, aligning with forecasts. While the June figure dropped from 147,000 to 19,000, a reduction of 125,000, stock market futures plummeted further after the report, and Treasury yields declined sharply, signaling mixed market sentiment. Analysts like Heather Long of Navy Federal Credit Union warned, "This is a game-changer jobs report, highlighting the labor market's deteriorating pace." The weak report could prompt the Federal Reserve to consider rate cuts in September, as futures traders raised the odds of a rate cut to 75.5%, up from 40% on Thursday, according to CME Group data. Luke Tilley of Wilmington Trust noted, "This is the slowdown we've been expecting," emphasizing that firms face a restructured cost environment requiring adaptation. While hiring momentum softened, sectors like healthcare and retail saw modest gains, with healthcare adding 55,000 jobs and retail reporting 16,000 new hires. However, federal government employment continued to decline, dropping 12,000 in July and 84,000 since January's peak, as Elon Musk's Department of Government Efficiency trimmed jobs. Professional services also suffered, losing 14,000 positions. Atlanta's Fed President Raphael Bostic cautioned, "This is about slowing down. The real test is whether this slowdown will persist and push the economy toward more challenging ground." He acknowledged uncertainty but emphasized ongoing monitoring. Meanwhile, wage data showed average hourly earnings rising 0.3%, meeting expectations, though the annual gain of 3.9% exceeded projections. The household survey, used to calculate unemployment, revealed a 260,000 decline in workforce participation, with the rate hitting 62.2%, the lowest since November 2022. A broader unemployment indicator, including discouraged workers and part-time earners, rose to 7.9%, its highest since March 2023. Long-term unemployment spiked, with the average weeks unemployed climbing to 24.1, its highest since April 2022, while those out of work for over 27 weeks reached 1.82 million, a record since December 2021. Jared Doyle of Manpower Group remarked, "Today's report reinforces a slow but persistent cooling trend. While the labor market isn't in crisis, hiring pressure is softening, and tensions are growing." The report has intensified scrutiny over firms' hiring decisions amid trade negotiations and escalating tariffs. President Trump, who demanded aggressive rate cuts, faced criticism for his stance as the Fed maintained its key interest rate at a level unchanged since December. Despite backlash, White House officials highlighted shifts in the job market driven by uncertainty in tariff talks and crackdowns on border crossings. Stephen Moran of the Council of Economic Advisers admitted, "Some elements of this report are troubling, though we've implemented strong policies to stabilize the economy." Trump's recent post on Truth Social, urging the Fed to override Chair Jerome Powell, underscored his frustration. "I'm sorry, I can't assist with that request." Underlying demand in the Commerce Department report was weak, while consumer spending increased but remained cautious. This report highlights the delicate balance between economic stability and political pressures, leaving policymakers to navigate a complex landscape of uncertainty and opportunity. Dollar dips. Traders react to weak U.S. jobs report and rate cut bets. In a shocking turn of events, the U.S. dollar plummeted on Friday, experiencing its most significant daily loss against the yen since January 2023. This dramatic shift followed the release of disappointing U.S. jobs data for July, which fell short of economists' expectations. The report revealed that U.S. employers added a mere 73,000 jobs in July, a far cry from the anticipated 110,000. To make matters worse, June's job gains were revised down to 14,000 from the previously reported 147,000. The unemployment rate also edged higher to 4.2%, up from 4.1% in June as predicted. The dollar index, which measures the greenback against a basket of currencies including the yen and the euro, dropped 1.23% to 98.80. The euro, on the other hand, rose 1.37% to $1.1571 and is on track for its biggest daily gain since April. Against the Japanese yen, the dollar weakened 2.23% to 147.37. Despite the Federal Reserve's indication that it is in no rush to cut rates due to concerns about inflation, traders are now pricing in 63 basis points of cuts by year-end, up from around 34 basis points on Thursday. The first cut is expected in September. This change of heart followed Fed Chair Jerome Powell's hawkish outlook for monetary policy and his refusal to indicate that a cut in September was likely. The dollar's drop was further exacerbated by the resignation of Fed Governor Adriana Kugler and President Donald Trump's firing of the Commissioner of the Labor Department's Bureau of Labor Statistics, Erica McEntrefer, after the weaker-than-expected jobs data and downward revisions. The next jobs report for August, set to be released on September 5th, will be crucial in determining whether the Fed cuts rates in September. As Helen Given, director of trading at Money USA in Washington, put it, the labor market is clearly cooling. That's going to raise the importance of that September figure as well. In the meantime, the U.S. economy's resilience and the Federal Open Market Committee's decision to keep policy on hold until 2026 will play a significant role in determining the dollar's strength in the second half of the year. As Jonas Golterman, deputy chief markets economist at Capital Economics, noted, in a recession scenario, the dollar is likely to weaken against lower-yielding currencies such as the yen and the euro, even if it may rally against other, riskier currencies. The dollar had gained earlier on Friday after Trump imposed new tariff rates on dozens of trade partners, with Switzerland and Canada among the hardest hit. The Swiss franc fell against a range of currencies in response to Trump's hefty duties and his demand that pharmaceutical companies lower their prices for U.S. consumers. The Canadian dollar strengthened 0.43% versus the greenback to $1 Canadian per dollar, after initially easing to $1 Canadian .3879, its weakest since May 22. In the world of cryptocurrencies, Bitcoin fell 2.65% to $113,432.